This is not, a narrow move to the downside. This is a big momentum move lower.
Absolutely, and you're seeing it really start off with that tech shares. No surprise here, really. When you see those yields spike, immediately people pull out of growth stocks. That's a relationship we know. What we didn't know was that this kind of sentiment would reflect across sectors. So you saw it in tech. But now it's taking down utilities, for example. It's taking down materials, even financials, which are said to actually benefit from higher yields. And I think that's a really interesting dynamic that you're seeing, that across the board, people are really getting spooked. And those energy names you mentioned in the green, that's really just a function of those OPEC comments you saw earlier.
I think it's really interesting that more and more we're seeing this negative correlation, Kriti, between yields and stocks, or maybe more basically, that bonds and stocks are selling off or gaining on a different day at the same time. Richard Cookson wrote a great opinion piece today about how this could be an early sign of a value at risk shock. Are you hearing anything else about that?
Well, people are definitely paying attention to those correlations, Matt, and I'm so glad you brought that up. I really want to bring your attention back to the tech field, simply because the S&P 500 and the NASDAQ are weighted so heavily for it. So what happens with tech kind of reflects across the broader benchmarks. But if you're looking at correlations specifically, yields are actually inversely correlated at the moment with the stock market, and that's actually something that's fairly rare. Right now it seems intuitive, but that's something that we've really only seen at the end of last year, and before that, dating all the way back to 2016. So it really tells you that this kind of dynamic where you start to see bonds and tech sell off at the same time, not only does it kind of confirm that tech has really served as that haven quality for a lot of investors, but simply that those kind of risks for the tech sector could really be at like I said, increased, accelerated as we see those yields surge even higher. And of course, we do know consensus expects that this is not the end of that yields rally.
And we obviously, we've seen that move into those yielding stocks, the value dividend parts of the of equities. There is, though, of course, this underlying logic. If the yield curve is steepening so much, as Brian Chapata just said, because of this Goldilocks scenario where inflation stays at bay, but growth is stronger than we had thought, that should be good for equities and that should be good for growth stocks. So what are you looking for here for the market to reach some consensus about what is at play here?
Well, you want a reflation rally, and a reflation rally really means not just one sector, not just the energies, not just the battered stocks really doing well. You want it to be evenly spread across the board, because it has to reflect that the economy as a whole, this is all very theoretical, the economy as a whole has to be lifted as well. So when you see those growth expectations, when you see inflation supposed to be generated in a good way, that should actually be helping even tech, which is supposed to be, even if it's a haven, it's still supposed to help their bottom line because it means more growth for their company. The yield curve, of course, is going to matter a lot for the bond investors, but I think the stock investors are literally only looking at simply the 10-year yield. I think it's as simple as that. They're not really looking into the deeper dynamics of the bond market.